One. Hi, this is Jeffrey Cohen, Chicago Quantum. How's everyone doing out there? We're just talking today about what we're working on. And so I woke up this morning and I had a lot of thoughts and did a lot of work documenting them. I really thought about, our model, right? What changes have to be made? And then, of course, I got distracted and I traded some stocks and I talked to some people and, did all that. But if I come back to it, what are we thinking here, right? Like, we kind of messed something up, maybe, or we're not being sophisticated enough in terms of the one metric that really matters in our model, which is what's the future expected return. So our model assumes a certain way to calculate expected market returns for the next 12 months. It is an academically rigorous process. It is from the 1950s. Now, I'm not saying they didn't have it right, but that's almost 100 years ago. That's 75 years ago, right? Or whatever. It's a long time ago. 73 years ago. So we got to come up with something better. So I got a spreadsheet here I'm going to walk you through, but the first thing I want to do is talk to you about what we're thinking. So, and if you have any comments or you have any thoughts, let me know. I'm not going to talk about individual stocks today. I could, and I'm sure you'd be all excited, and maybe at the end I'll give you a little something, but for right now. So, maybe when we look at our stocks and our indices, we should be looking at mean, median, mode. We should also be looking at the frequency distribution and what are the 95% probability changes. Now, what would that tell us? So, for any individual stock, we might still get the same answer. This is the portfolio. But if you're looking at individual stocks, it might be nice to know how wide the changes are that you might expect if you buy the stock. And looking at past year, you could calculate those frequency distributions. Might be helpful. I'm investing in a real kind of very, very risky, volatile pair of positions. One's long, one's short. There's times I want to pull the hair out of my head because you could see a 5 or 10% change in the value of the portfolio in a day. That's like heart attack, right? So maybe it might be nice to know what the 95 percentile changes are. The next is, maybe it might be nice if you're just looking at stocks. What's the daily price? And that way you can start to get comfortable with if the price is moving or changing. We already have market cap, but we could market cap weight the optimization. That adds a few more lines of code, maybe a few more hundred lines of code. But if you market capitalize the portfolio, that should reduce the investor's risk. It's interesting. We also could look at the change over a certain time period, and this is where like the little spreadsheet I'm pulling is good. But so right now we do everything on a 1-year basis, right? 1 year. It's easy. It's 253 trading days. Everything. But what if instead we looked at the 20-day or the 50-day and we were looking for a more aggressive sense of momentum of the stock? That could be really interesting. Now, I'd want to run it 10, 20, 50 days and see what comes up. It's an interesting thought, and we could just analyze the data that way. But so shorter time frame. The other thing is we need a way to estimate expected return to stocks. So what we do now is we look at the return from the past year and we project it forward. So stocks are going up or down, that's interesting, right? It just assumes a ball thrown through the air continues at the same trajectory. But what if stock prices are in for a shock based on our 10 forces? Based on the top 10 forces that affect the stock market. And you remember these. I've made a few videos on this. Top U.S. stock market drivers. They're things like volatility. And by the way, this stuff, these factors, are based on beta of the factors. So they really are influential on stock prices. But what if we just came up with one number that somehow tracked these? That's what I'm working on now. The second is there something about share price momentum? Is there something about high yield corporate bonds, real estate values, metals, energy, the value of one US dollar against foreign currencies, the price of gold, treasury long bonds, and real interest rates on bonds, risk-free US treasuries, US government cash intake, right? What is the impact on liquidity from the US government? And then Bitcoin price. Now, Bitcoin price, I don't really know. That's an experiment, right? But that's cool. What if I had, how did the stocks do for the past year? And then I had this like composite index value. I think that's super powerful. That's going to add a lot more intelligence. So I'm working on that right now. So, and before I start coding, what I'm trying to do is create a spreadsheet, see if the spreadsheet has some impact, and take a look at some of the research I've been doing. I've actually pulled together a bunch of tabs in Yahoo Finance, and I look at things like, as an example, Mortgage News Daily, who I don't pay and they don't pay me. But wow, they do a daily mortgage rate survey. 7.81% is the 30-year fixed conforming mortgage rate in the United States. I mean, we can look at other stuff, but mortgage prices are significantly weaker so far today, which means the rates go higher. We're going to look tomorrow. We're going to see what that is, and that might tell you something. Mortgage rates go up. Probably not so good for the real estate market. There's other things we look at. Let me see if I can find one. Yeah, what is the Chicago Mercantile Exchange FedWatch? And this changed today, actually. It was pretty cool. So this is the probability or likelihood that the Fed will change federal target rate or policy rate the next meeting in November 1st. 15% they raise by a quarter point. That's cool. If that was 0, that would say a different message than if it's 15%. And there's so many of these. So I care about things like secured overnight financing rate. The cost that a company will pay if it has an adjustable rate mortgage plus some kind of spread factor. And so it's 5.32%. That's interesting. What if it goes up a basis point, 5 basis points, or 0.05%? My guess is that those companies' interest expense, starting at that moment, will also go up, or starting the next day. You got to know this stuff. And so we're going to track all this stuff, right? And we're going to try to create a composite metric. And then we're going to somehow figure out how to apply that in a reasonable way so that we can figure out what the expected returns are to risk. So I tried to figure out, is there a momentum index? And guess what? I can't find one. So maybe I have to do something else, right? And so we run something that feels like a momentum index. It's actually our own expected return. And so maybe we throw that in the pot, right? Expected return, 1-year return to risk. Now, this is the return to risk, not the total return, because you have to subtract out the risk-free rate of return that you would expect to get because you can put money into a risk-free rate of return. So it's interesting. We're going to have high-yield corporate bonds. By the way, high-yield corporate bonds, if I can find it, is HYG. Now, what we're trying to do I'm mocking something up with Google Finance, but I wouldn't use that for the model. But HYG is an iShares high yield corporate bond ETF. And so if you look at it, it's not a bad proxy because as the bonds are worth less, the yields are higher. And so here you go. And so I'm going to be setting all this up. We're going to come out with some composite risk on, risk off, or some adjustment factor. And I think this has a ton of value if you're in the market every day. Because in the morning, wouldn't you want to know? Or from the run the night before, wouldn't you want your model to somehow help you? And to say, oh yeah, this is from the 4th. This is old. This is from Friday market close. And you'd say, all right, Jeffrey, tell me the story here. I got an expected market return of 8.21%. Hey, that's great. But what about my factor? Am I going to be good on Monday? Is it rough? Are bad things happening to interest rates? Are bad things happening to inflation? Are bad things happening to the dollar, to the VIX? What about real interest rates? What about labor cost changes? What about the SOFR, or Secured Overnight Financing Rate? Jeffrey, what's happening in the market that might affect prices? Now, there's a bunch of stuff that is qualitative, such as threat of war, customer delinquency and threat rates, corporate income tax changes, bankruptcy ratings, labor actions, tariffs. Yeah, that's getting a little crazy, and those are longer term factors that we won't change every day. But you know what? War in Israel is not good for the United States equity market. And you saw what that did this morning. This morning it pulled equities down almost a full percent. Now, by the end of the day, equities were fine, right? War in Israel doesn't mean war in the United States. But threat of war is always a factor, right? When Russia invaded Ukraine, that was a threat of war. That's an issue. For sure China starts circling Taiwan, even without shots fired. That increases probability of war. And so things like that you have to capture. Bankruptcy filings. I'm going to find a really good data source. I might have to pay for it. But what is the number of bankruptcy filings made, let's say, in the last week? And what are the size of the asset bases? That'd be cool to know. And so this is what we're working on. If you want to be part of this, shoot me a message. Now, the best way to reach me, the way that I'm not going to kind of feel funny, you can call me on my cell phone. I think that's great. Maybe hit me up on Twitter. I say that because if you're in this game, if you're in FinTwit, then you already know who I am. I already know who you are. But let's say you don't. Go look at Chicago_Quantum. Chicago Quantum, this is me. I got a picture of me. It looks just like me. I had a little less gray back then, but whatever. It's Jeff Cohen, right? So send me a message. Just shoot me up. New message. Hey Jimmy, how you doing? Hi there. Did you have a good day today? And what's going to happen is I'm going to respond to you. I'm going to answer you. We're going to have a phone call. We're going to exchange phone numbers. It's going to be great. But then I'm going to know that you're out there. So that's what I recommend that you do. Go for it. Hit me up with a message, right? Direct message in Twitter. You could send me an email, right? You can go to my website, right to the main page, home, chicagoquantum.com. There's a phone number, right? There's an email, but I might get nervous if I don't recognize your number. So hit me up, however you want to do it, and I'd be happy to work with you. And then, of course, share the results, share the code, whatever, in terms of this mock-up that we're doing on daily price changes. And if what you propose is helpful, I'll give you a free run. Maybe I'll give you a few more than just one free run. I'll hook you up. I'll let you know what stocks are moving. What's the optimized portfolio? You can get that just by being part of the team, being helpful. Otherwise, you got to go to advisory services and you got to buy an advisory service. Stock analysis, it's not that expensive. I lowered the price 90% because I wanted to make this affordable for most Americans. If you're overseas and you're paying with foreign currency, let's say you're from Turkey, I'll work with you because I know that 100 US dollars in Turkish lira is going to be super expensive. So if you're coming to me from another country, a poor country, if you're someone maybe who's hard up, who doesn't have a lot of money to invest, really, really low income, I'll work with you. Don't worry. You can afford the run. So here, you want a short run, it's $100. I get you all kinds of good stuff there. Lots of disclosures, lots of descriptions. But net, you're going to get some very interesting information about the market. And so, there you go. Hey, thanks for watching. If you have any questions, give me a shout. And I'll let you know as I build this whole composite and as I add some deeper frequency distribution metrics and some other kind of statistical distribution metrics to the output of our model. Because I think clients are going to want to know, right? If I buy a stock, I will be done in a moment. If I buy a stock, I sell a stock. What kind of volatility am I really facing here? What's the risk? All right. Hope you had a good day today. Hopefully you made money. And talk to you soon. Bye-bye.